I'm so sorry, ma'am. I know you need this medicine, but it looks like it's not covered by your insurance.
Yeah, unfortunately, I had to deny that one.
Wait, who are you?
I'm your insurance company's pharmacy benefit manager. I get paid based on the price of a medicine, and I don't make as much money off this one.
No one should stand between you and your medicine. Visit phrma.org/middleman to learn more. Paid for by Pharma.
This is Optimal Finance Daily, episode 2393. Getting a Mortgage When You Have Assets But No Income, Part 2, by Darrow Kirkpatrick of CanIRetireYet.com. And I'm your host and personal finance enthusiast, Diana Merriam. Today's post is a continuation from yesterday, so if you're new here, I'd recommend listening to yesterday's episode first. But if you're all caught up, let's hear Part 2 and continue optimizing your life. Getting a Mortgage When You Have Assets But No Income, Part 2, by Darrow Kirkpatrick of CanIRetireYet.com. Exploring local options. After talking with 2 national companies, I decided to contact local mortgage brokers in a couple of regions where we could conceivably settle down if not New Mexico, Colorado and Tennessee. Both contacts were helpful, but neither turned out to be as competitive as Schwab/Quicken Loans. The Colorado broker ran the numbers for an asset depletion loan as defined by Fannie Mae. In this case, the loan amount would be based on retirement assets only, with a 10% reduction since we were younger than 59 and a half. A 30% down payment coming from different assets would be required. The calculation then simply takes 70% of the retirement assets and divides by 360 to produce an eligible payment amount. Next, I spoke with a friend of a friend in the mortgage business in Tennessee. His company had offered a Fannie Mae asset-based loan before a recent ownership change. Now they could offer an asset depletion program with generous loan amounts, but not so competitive interest rates. Their formula used a straight 15-year depletion with no growth. So it simply divides your total assets by 180, 15 years times 12 months a year, to get a payment. In our case, the implied loan amount was 2 to 3 times the size house we had targeted. So no problem with the loan amount, but the rates were nearly 2% higher than the other options. So this quote was a non-starter given the much lower rates we'd already been given. The broker did helpfully suggest that we try working with a local bank in town, which held their own mortgages, sometimes called a portfolio bank. They might be able to give us a better rate. Alternatives to getting a mortgage if you don't have income. Given my research, it seems we'll have no trouble qualifying for an asset-based mortgage with Schwab/Quicken Loans being the leading contender. But if we couldn't qualify, what would be our other options? Number 1, manufacturing income to get a mortgage. For starters, could we just produce more income to show on our 1040? Yes, in theory, we could tilt our investments towards dividend payments, and/or we could harvest more capital gains than needed for our retirement living expenses. This artificial investment activity would likely cost us in fees and taxes, but might be worth it if we could qualify for a mortgage no other way. However, according to one of the loan officers, we'd need at least 2 years of tax returns showing adequate dividend income, and banks are skeptical about counting future capital gains. The burden would be on us to prove those could continue for at least 3 years. Number 2, security-backed line of credit. So I explored another option, sometimes called a security-backed line of credit. This is not a mortgage loan secured by real property, but rather a line of credit secured by your investment securities. I called Schwab and talked to a regional banker about their pledged asset line to find out how it would work. Compared to most housing loans, the terms are blessedly simple. They will loan you up to 75% of your total liquid non-retirement assets for a term of 5 years, which can be renewed. There are generally no fees, and as long as there is credit to cover the amount of interest due, no monthly payment is required. The quoted interest rate, variable and possibly negotiable depending on your assets, was pretty competitive. But there are downsides. The assets you pledge as collateral must be held in a separate account. You can trade in that account, but you can't make withdrawals without the bank's consent, so you couldn't tap that money even for a short-term emergency. Secondly, if the value of your investments decline by more than 10%, you'll need to deposit money or sell securities, possibly at a loss, to avoid a default. It's very similar to a margin loan, though with slightly more generous parameters. For me, that's just too risky. Buying a home is stressful and expensive enough already, without introducing market risk into the equation. And number 3, home equity conversion mortgage for purchase. The last option for some who want to finance a home without steady income in retirement is known as a home equity conversion mortgage for purchase. This uses a reverse mortgage at the time of purchase to finance a portion of the home. But it often covers only about half the purchase price. You would need cash available to pay the difference. And since all owners must be at least age 62, this isn't an option for us yet. Finally, given that reverse mortgages are complex and potentially expensive, this approach should be a last resort for many. Buying a house or not. So I've learned that if you're a retiree with little to no documented income but plenty of assets, you can certainly get a mortgage to buy a house, and you can probably find a competitive interest rate, but you'll need to shop around. Some mortgage brokers won't be familiar with these asset-based kinds of loans, and others won't necessarily have competitive products to offer. In our case, it's a relief to know that if we find the ideal home for our golden years, we can get the financing to buy it without having to sell assets and incur large capital gains in a single year. That solves the financial problem, but leaves the emotional one. Do we really want to complicate our simple renter's life with the obligations, constraints, and risks of home ownership? Are we ready to commit to living in one area for the years it would likely take to recoup our transaction costs? If not, a blunder of the magnitude involved in purchasing a house could severely damage our financial independence. You just listened to part 2 of the post titled Getting a Mortgage When You Have Assets But No Income by Darrow Kirkpatrick of caniretireyet.com.
I'm so sorry, ma'am. I know you need this medicine, but it looks like it's not covered by your insurance.
Yeah, unfortunately, I had to deny that one.
Wait, who are you?
I'm your insurance company's pharmacy benefit manager. I get paid based on the price of a medicine, and I don't make as much money off this one.
No one should stand between you and your medicine. Visit phrma.org/middleman to learn more. Paid for by Pharma.
This episode is brought to you by Google. Cyber attacks on critical infrastructure threaten essential services. That's why public institutions like schools, hospitals, and government agencies across the country are partnering with Google to keep their data safe and secure. Because when organizations run on Google Cloud, they're defended by the same AI-powered security that protects all of Google. Explore how Google is keeping more Americans safe online. Visit safety.google/cybersecurity today.
I thought the security-backed line of credit in this article sounded familiar, though Darrow specifically says they are different from a margin loan. However, this reminded me that I read an article from Mr. Money Mustache where he did buy a house with a margin loan. The article was titled, "The Margin Loan: How to Make a $400,000 Impulse Purchase." Basically, what happened is that Mr. Money Mustache had an opportunity to buy the house next door to him. His friend really wanted it, but due to their self-employment income, a mortgage was going to be tough. And they knew that an all-cash offer would be more successful than if they got into a bidding war. Mr. Money Mustache was willing to front the all-cash offer until his friend could get the mortgage, but didn't have $400,000 of cash sitting around and didn't want to sell investments that would trigger capital gains taxes. So what he ended up doing is transferring some of his existing investments to a brokerage that allows margin loans. This allowed him to borrow money against his own shares at an interest rate of about 1% without selling any of them. The result is like a very flexible mortgage, but at less than half the interest rate and with a virtually overnight origination speed. Now, this was a very specific situation where a margin loan was used to buy a house, but many will use them to buy additional stock, which comes with considerable risks. This isn't like a bank loan, and brokers can call in their loans at any time and expect immediate payment. So if you don't have the capital to repay your margin loan immediately, you probably shouldn't take the loan. Well, that'll do it for today. Thanks so much for being here and sharing the show with others. And I'll be back tomorrow with more Optimal Finance Daily, where your optimal life awaits.